to ask you first about the move in U.S. Treasury yields, really. Not a lot of change in terms of the macro fundamentals, but there seems to be a bit of expectation here that we could be getting a move in the yield environment. What is your take?
Well, we're seeing, I think, what is to be expected. The Federal Reserve is likely to raise rates 3 times this year. Inflation is picking up marginally, and so we're seeing some reaction in the fixed income markets. It's hardly a dramatic reaction. And remember, the 10-year yield in nominal terms is well below the nominal rate of GDP. So this is still an extremely low yield from an economic perspective. It's got very little economic impact in that sense. But I think that the market is simply starting to price in some of the realities of an economy that's performing okay.
Yes, and you do make a good point there, not to get too excited because it's not overly dramatic at this stage when we talk about 2.7. I also am curious, though, if you've been surprised by the dollar moves with the yields, because some have said, you know, we really should see the dollar be moving higher in line with the yield moves. Hasn't exactly been the case. I know it was the case overnight, but not always the correlation that one would expect.
Well, I mean, the fact is that interest rates are not nearly as significant to currency markets as they were, say, 30, 40 years ago. If we go back to the 70s or to the 80s, then fixed income flows were the only game in town when it came to international capital flows. But now fixed income flows are one of the least important drivers of global capital flows. It's foreign direct investment and it's equity flows. And the relative valuations of US equities are not perhaps terribly attractive. Foreign direct investment into the United States is not really showing much signs of accelerating. And so that presents a problem at a time when Mr. Trump's tax cuts are likely to increase the size of the current account deficit and increase the pressure on the dollar.